here. It's trading the fall in metals on Monday afternoon here from the small exchange. Metals have been, as I've touted many times with my co-host Peter Molmap, one of the best asset classes for us here in the last several months, maybe even since the pandemic broke out in early 2020. One of the more consistent trades here. We saw those new highs get put in gold, new, I think, all-time highs going back to the 90s and even farther back than that. And since then, if you were able to withstand that outlier, this has really been one of the most consistent back and forth trades as equities have trended in one direction, currencies have trended in one direction, interest rates now actually seeing a good amount of two-sidedness, but that was a one-way trend for a big portion of the last year's worth of trading. So an asset class that I've been constantly advocating for and trying to get people a little bit more comfortable in here. I know it's not as flashy right now as your corns and your soybeans or your Doge coins in the cryptocurrency space, but one of the most consistent trades for those of you who are actively scalping markets. So let's get into it. Let's get a little context and then maybe arrive at a trade given today's action, actually the fourth day in a row here that we're higher in metals. But let me give you a little bit of historical context for today's metal trading. Metals have made a break for last year's highs once again. And what's interesting here is you have two metals markets here, gold and silver, probably the most commonly traded of the metals, although copper has started to move a lot more. But we're focusing on precious metals. Copper is a base or industrial metal. Precious metals here, stores of value, less practical uses, more just valuable assets here. And these are very highly correlated going back the last decades, gold and silver. But that doesn't mean that they can't move differently. They move most of the time in the same direction, but they can have a lot of different movement in terms of the amount, the magnitude of those moves. And so what you see here from the start of 2020 until right now, you see a huge rally in that white line, gold. And like I alluded to earlier, gold put in new, fresh all-time highs since the 90s, above $2,000 in the middle of 2020. And now you saw the rally in silver, but not nearly to the extent as we saw in gold. Since those highs, markets have backed off a little bit, but we've seen a big rally the last couple of weeks here in metals, especially the last couple of days, big moves higher in both gold and silver. But you have now a scenario where silver is actually getting closer to those highs of last year. And once again, it's try to keep track of these things in your mind. Silver highs of last year weren't as high as the gold highs, but now we're seeing silver get back to those not as high highs as gold is rallying, but not nearly as much. A lot of highs there. We're hopefully seeing some lows to come in metals because it's been a one-way trade, and that's what we're looking at here is trading the fall. But I want to give just a little bit further context. First, just to show you that these highs here in gold that we're looking at from the early part of last year were above these historical highs of, I call it like 2011, 2012. And we're pretty close to those in gold, but yeah, like I said, not moving nearly as much as silver now that we're in 2021. But you get a little bit of a sense of like where we're at in the grand scheme of things. We are at historically inflated prices for gold and silver. In the last few days here, 4 days in a row, higher in both gold and silver, really seeing the full extent of that trend. And what's interesting about commodities relative to equities, like we do a lot of studies on gold and silver where it's like 4 days in a row higher, close to historical highs here, maybe look at a short strategy. And we don't do the same in equities because you tend to see a little bit more range boundedness in these commodity asset classes relative to those equities. I mean, take, for instance, the S&P 500, a stock index that's been around for a while. There's turbulence and there's stock market crashes and everything else. But if you take an average price in the S&P in the 90s, compare it to the 2000s, compare it to the 2010s, and compare it to right now, it's going to be higher in each of those ensuing decades. And right now, we're actually sitting at all-time highs in those equity index asset classes. And so we aren't necessarily looking to say, oh, equities are high, we're going to sell them, because there's not a ton of range boundedness there. But I do like looking at all of this context within gold and silver and saying, man, there might be a decent short trade, and there's been a decent short trade at these highs for the last year and a half, going back to the big run-up of the summer of 2020 to those fresh highs in gold. And now we're looking at the small metals futures here, which is a smaller trade compared to gold and silver futures, which I think gold at one point was up about $1,000 just today. That's a big future there. The small metals futures, I think at the highs were up about $70, $80. That's just to give you a little anecdotal evidence to how much smaller these metals futures are compared to gold. And then also, I think the buying power to trade a gold contract right now is in the thousands, whereas in small metals, I think it's right above $500 to get one of these contracts on. But anyways, looking at this trade, it is as simple to me, and it has been as simple in the past as we've looked at trading small metals, as like it hasn't broken below $70, and we've looked at long strategies when it got down to 70, and it hasn't broken above $80, except for that one little outlier move as gold got to those highs. And like I said, they're not nearly through those historical highs right now. And so this is what we're talking about when we say trading both sides of a market, or trading the range, is being able to, as recent as a couple of weeks ago, buy this metals market now as it's ascended 4 days in a row, as it's gotten closer than it has in the last couple of months to $80 in small metals. Now we're looking at trading the potential fall here in metals. Now, of course, it could go up to 85. Gold could go through 2000, those highs for the last several decades. Of course, these markets can go anywhere, but we do have the historical edge on our side here of not breaking through $80. So markets at about $78 right now in small metals futures. How do I get this little leeway taken care of, the difference between 78 and 80? Well, we can use a strategy here that I've looked at employing several times in recent months, which is appending the short metals position with the ETF options position. Now, why wouldn't you just go ETF shares to ETF options, or just ETF options in general? Well, you're not getting as good a bang for your buck. The ETF shares are extremely costly, margined about 50%. Right now, the capital requirement in percentage terms on small metals is less than 10%. Like I said, $500 there for that margin in the small metals contract. And then we can use the put spread in GLD, which is defined risk and thus not margined at that full 20 to 30% like options, ETF options are usually margined at. We got the spread there. And then also SLV being a smaller ETF, the naked options there actually aren't that costly. So what I'm in essence doing here is pairing up the futures, very efficient with your capital, with ETF options, relatively efficient with your capital, but we are using the spreads in GLD and the naked options in the smaller priced SLV. So we are doing a pretty good job of staying efficient in that space to get short metals at around $80. How can you do that? Any number of ways. Here I'm looking at, you could do one wide put spread in GLD, or two maybe $5 wide put spreads, I guess thinner put spreads in GLD per one SPRE contract. Or what I found is the easier option, or maybe not the easier, but the simpler option, is just 2 or 3 SLV puts. And I was looking at the ones that are maybe 1 or 2 strikes out of the money in SLV and doing 2 or 3 of those. What you in essence want to do is say, okay, I'm short SPRE at about $78. I need to collect close to $2 in credit with either the put spread in GLD or the naked put in SLV. However you want to do that is kind of up to you, depending on expirations, how aggressive you want to get. The only thing that I would put out there is to not get too large in GLD. You don't want to get too large in either of them, but SPRE futures are worth about 300 to 400 shares of SLV. So you can comfortably do 2 or 3 naked options in there without outsizing your hedge against the outright short in the futures contract. But in GLD, about 50, 60 shares of GLD equate to one futures contract in the small metals. And so what you don't want to do is at the end of the day have like 75 or 100 deltas, like a full naked put that would be in the money in GLD would be outweighing the SPRE contract there. That being said, you could do 2 short SPRE contracts to 1 naked option in GLD. So those are the baselines for getting the trade on. Of course, you can make it however you want, but these are some nice pieces of historical context and some current practical ways to trade the fall in metals.